Hi there, accountants. I hope all is well, and I pray that as you're viewing this video, that you're in the best of health and spirit. This video will cover several questions from chapter 15, which covers leases. So in chapter 14, we essentially learned about how companies accounted for long-term debt, and it was essentially focused primarily on bonds and notes. But in this chapter, we continue the discussion on debt, but we now focus on liabilities that arise in connection with leases. So just to ensure everyone understands, a lease is a contract that gives a lessee, which is essentially the user, the right to control the use of an asset for a period of time. The lessee pays the lessor, who is the owner, for that right, typically with a series of payments made over the lease term. So to make it very simple and but easier to understand, let's say if I lease a brand new car, I am the lessee, the user, and let's say Lexus would be the lessor, and I would pay Lexus $300 a month to use a 2025 RX 350. All right. So again, this happens in our everyday lives, in our individual everyday lives, and the same thing also applies to businesses. Businesses also lease. So there's some key things to keep in mind before we get into the first question. So sometimes the lessee, the individual, the user, the business, they will account for this arrangement. They'll record a right of use asset, right? Because once you lease a car, the car doesn't really belong to you. At the end of the lease term, yes, you might have the option to extend the lease term, or you might have the option to buy the asset. But again, the key thing is you're using, it's like you're using this asset essentially just for the period of time. But again, in the future, you can decide to keep it. And in some situations, the lease contract, it might represent the sale of an asset. So we're going to look at some distinctions between a finance lease, and then we'll also talk about operating leases. So here we start off with this first question, and it asks, how should this lease be classified by Mid-South Urologist Group and by Physicians Leasing? Prepare the appropriate entries for both Mid-South Urologist Group and Physicians Leasing from the beginning of the lease through the second rental payment on April 1st, 2024. Adjusting entries are recorded at the end of each fiscal year, December 31st. And lastly, assume Mid-South Urologist Group lease the literature directly from the manufacturer. Rand Medical, we'll just call it the Lith object, all right, Rand Medical, which produced the machine at a cost of $1.7 million. Prepare appropriate entries for Rand Medical from the beginning of the lease through the second lease payment on April 1st, 2024. So here we see Rand Medical manufactures lit objects. Litropsy uses shock waves instead of surgery to eliminate kidney stones. Physicians Leasing purchased the lit object from Rand for $2 million and leased it to Mid-South Urologist Group Incorporated on January 1st, 2024. So here we see there's a description of the lease. We see that there's quarterly lease payments. And what this simply means is that every 3 months, or every 3 months, 4 times a year, they're going to be paying $130,516. The lease term is for 5 years, and I want you to understand why it says 20 quarters. So in each year, there's 12 months, and if you're making a payment every 3 months, that means that you're making a payment 4 times a year. So therefore, 5 years times 4 payments per year, that represents 20 quarters for which payment is going to be made. So please just keep that in mind. It says there's no residual value, no purchase option. The economic life of the lit object is 5 years. The implicit rate in lessee's incremental borrow rate is 12%, and the fair value of the asset is $2 million. All right. So obviously there's a lot going on in this problem. We're looking at some terminology that we might have never seen before. And again, now we want to know, how is the company going to record it? And we're looking at it from both angles. We're looking at it from the lessee, the user, who's the individual or the business, and the lessor, who is the company or the individual that is providing the asset for the lessee to utilize. So If you've ever leased an apartment, again, a lease is basically a contractual agreement, right? So with that contractual agreement, you are saying this person can use this item for XYZ amount of money, essentially, right? So one of the things with a lease is it ultimately depends, it needs to be classified correctly. So we have what's called, well, based on some requirements that must be met, it helps you to classify how the lease, or to determine rather how the lease should be classified. So the way we account for the lease, it ultimately depends on whether the lease more naturally resembles the purchase of an asset with debt finance, or whether it's basically just like a rental agreement, right? So in most cases, the nature of a contract, or the nature of the contract, it's relatively simple, right? You read through the contract and it basically lets you know what's going to happen. For example, let's say we have a 5-year lease for a computer, non-cancelable, can't cancel it. But the title passes to the lessee at the end of the lease term. In such case, that represents more of a purchase, right? Because at the end of the 5-year period, the company, the individual is going to own that computer. So in such cases, that's classified as a finance lease by the lessee and a sales type lease by the lessor. But on the contrary, let's say a business, they are renting a computer for a special event. In such case, and they have a 30-day rental. At the end of that 30 days, the business has to return that computer. They are not going to own it after the 30 days. So therefore, because there's no passage of title to the lessee, that would represent a rental and not a sale. So those types of rental agreements, those are referred to as operating leases. So again, this first part of the problem is asking us to clearly determine how should the lease be classified to Mid-South urologists and to physicians leasing. So based on that information, what we just covered, so again, we have this quarterly lease, the lease term 5 years. In such case, we see that this seems as though, at the end of the year, at the end of the 5 years rather, they have the opportunity to be able to keep the lit object if they decide. So in such case, to the lessee, this is a finance lease because again, it's not like they're just renting it. Physician's lease in such case would be considered a sales lease. And then one key thing to keep in mind, there's a back end to it, right? So there's some questions that you would consider to need to be asked. There's what's called a classification criteria. And based on the classification criteria, that is essentially how we determine how the amount, or how the lease rather, should be treated. So in order to determine that, I'll pull this up quickly. So the classification criteria is as follows. We classify a lease transaction as a finance lease, sales type lease from the lessor's perspective if one or more of the 5 criteria listed is met. Otherwise, it's an operating lease. So this is the illustration. The agreement specifies that ownership of the asset transfers to the lessee. Nothing in the problem essentially lets us know that. But again, one or more, so 1 out of the 5. The agreement contains a purchase option that the lessee is reasonably certain to exercise. The lease term is for the major part of the remaining economic life of the underlying asset. So, let's see. The lease term is 5 years. The economic life of the lit object is 5 years. So therefore, that criteria is met. The lease term is for the major part. They're using this lit object for the entire economic useful life. All right. So in such case, again, if none of these 5 criteria is met, then it is treated as an operating lease. So we'll move on with this question. Requirement 1, for Mid-South urologists, the lessee, it's a finance lease. For physicians leasing, it's a sales type lease. So for requirement 2, it's asking us to prepare the appropriate entries for Mid-South urologists. So in such case, the journal entries are going to be as follows. So as mentioned, we record it as a right of use asset. So the first part of our entry is going to be the right of use asset And it lets us know that the fair value of the asset is $2 million. And we also want to determine, all right, what is the present value of the periodic lease payment? So in order for us to determine that, we would also use our present value of annuity. So we would factor in the payments that we're going to make each period, which is $130,516. And then we see here that the interest rate is 12%, and the payments are going to be made 4 times a year. So therefore, here we have our present value of an annuity due. We know that the lease term is 5 years, but we're making payments 4 times a year. So 5 times 4, there's going to be 20 periods. And in regards to our interest rate, we see that the interest rate is 12%, but we're going to be making payments 4 times a year. So 12% divided by 4 gives us 3%. So therefore, we basically connect the dots. So we get our present value of an annuity due factor of 15.32380. So therefore, 150,000, 130,000, sorry, $516 multiplied by our present value factor of 15.32380. And if we round it, so that gives us about $2 million rounded. So that is essentially equivalent to the fair market value. All right. So that was just, tying into one of the criteria. So you just keep that in mind. So our journal entry is going to be as follows for January 1st. Once we first get the asset, we would debit our right of use asset, and we have a liability we need to pay. So we would credit the lease payable for $2 million. So that's the journal entry for the lessee for January 1st. Next, we need to factor in, it says that there is a payment each quarter of $130,516. And at the beginning of each period. So therefore, the first journal entry that we are going to make is for the payment. So we would debit our lease payable for the $130,516, and we would credit cash because we're paying cash. All right. So in this example, keep in mind, on the same day for which we made a lease of this lit object, we also made a payment. So therefore, no interest has accrued thus far. So now we move on to April 1st. And now at April 1st, some time has passed. So therefore, based on that fact, there is some interest that has accrued, and we would essentially need to calculate how much interest has accrued. So in order for us to calculate it, I already have the calculation here to make it easier. So we would factor in our interest expense. And again, it's 3%. Because the payments are made every quarter, we would divide the yearly interest of 12% by 4. So 12% divided by 4 gives us 3%. So we would factor it in as follows. And again, if you think of it like a T account. So with our T account originally, and our lease payable account, we had a balance of $2 million. So here's what we'll do. We will quickly create a T account. So we have our, just so you can understand the concept moving forward. All right, so here is our T account, right? And one of the key things that we see is that we initially, once we set up the journal entry, we had a credit for the $2 million. And then now here we see is that on January 1st, we had a decrease to the balance of $130,516 because the entire amount of our first payment was allocated to the lease payable. So as of April 1st, the balance in our lease payable account is no longer $2 million, but it's $2 million minus the $130,516. So we have a balance of $1,869,484. So based on that information, that is how we determine the interest expense. So first part of our entry would be interest expense. And then from there, We have the 1,869,484, which is the current balance of this liability, multiplied by 3%. So therefore, the interest expense for that period for April is $56,085. So we use what we know to figure out what we don't know. So we know that each period we're paying the same amount of cash. That'll never change. We're always going to pay $130,516. What does change, however, is how much is going to be allocated to interest and how much will be allocated to the liability. So in this case, the decrease to our lease payable account will be the difference between the cash we're paying each quarter, which is $130,516, minus the interest expense, which again is based on the carrying value of the liability, which was the original balance from our first journal entry. We created the liability with a credit, and then we decreased the liability by $130,000. That gave us a balance as of April 1st of $1,869,484, and we multiplied it by the quarterly interest rate of 3%. So therefore, the journal entry would be as follows: a debit to interest expense, debit to lease payable, and a credit to cash for the respective amounts. So that's our journal entry for the lessee. For the lessor, our journal entry would be as follows. So same thing for the most part, but now it's on the reverse. Instead of for the individual that is using the asset, we now record a journal entry for the individual that is granting the right of use for the asset. So our journal entry would be as follows. For physicians leasing, so we would debit lease receivable, right? We are expecting to receive money. So lease receivable for $2 million. And then we will credit the equipment. All right. So again, because this mimics like the sale of an asset, in such case, we take the equipment, we take the lit object off of our books. So just keep that in mind. If it were an operating lease, it'll be treated differently. But in this case, it's as though, because again, the economic life, it's 5 years and the lease term is 5 years. Rand Medical is essentially, Mid-South urologists, they're using up this asset. So January 1st, we would debit cash, credit lease receivable for the $130,516. And then now on April 4th, well, we know we're always going to receive $130,516. Never going to change. But we need to determine, okay, in this case, how much is our interest revenue? All right. And again, this is fairly similar to the journal entry that we just saw for Mid-South. So here's how we would calculate it. Similar, instead of lease payable, so instead of lease payable, we would look at the lease receivable. Same concept. All right, so I'll just type it in. All right, so we have lease receivable All right, so it'll be factored in as follows. So with this lease receivable, we originally started off with a balance of $2 million, as we see here. So we would debit the account for $2 million. And then our next step will be, okay, what else happens? In addition, there was a credit, as we see here, of 130,516. So we see that as of April 4th, the balance in the lease receivable account is 2 million, which was the original balance recorded on January 1st, minus the first payment. So therefore, the interest revenue is going to be calculated as follows. The interest revenue, which is the balance in the lease receivable, multiplied by 12% interest divided by 4 payments per year, which is 3%. This is to be J20. So therefore, our interest revenue will be 56,085. And similar to the problem before, our lease receivable would be the difference between the cash received and the amount that was allocated to the interest revenue. All right, so fairly similar entries. The first part was for the lessee, and the second part was for the lessor. Now we move on to requirement 3, and requirement 3 states, assume Mid-South urologists lease the lead object directly from the manufacturer, Rand Medical, which produced the machine at a cost of 1.7 million. Prepare the appropriate journal entries for Rand Medical from the beginning of the lease through the second lease payment on April 2nd. So our journal entry would be as follows. So again, this is assuming they went through the manufacturer, or they leased directly from the manufacturer. So the journal entry would be as follows. So we would debit lease receivable for the 2 million. Let's see, 0. And then we know that they would have to write or factor in rather the sales revenue. So in such case will be sales revenue for the 2 million. And then now we need to factor in, all right, it says here that they produced the machine at a cost of 1.7 million. So again, we credit sales revenue because this mimics a sale rather than a rental. So the next part of the entry, again, we know in accounting, we always put all our debits first, is they manufacture this item, this machine, at a cost of 1.7 million. So we need to factor in there's gross profit. So we know that sales minus cost of goods sold equal gross profit. So we factor in the cost of goods sold, which in this case is 1,700,000. And then from there, they would write off the books the equipment, which was recorded at 1.7 million. So that would be our first journal entry, because again, we're recording the entries for Rand Medical. Now on January 1st, the journal entry would be similar to what we saw for physicians leasing. So we debit cash, we receive 130,516. We credit our lease receivable for the 130,516. All right, and again, as mentioned earlier, it's the same logic as we now go to prepare the journal entry for Rand. So we factor in the lease receivable. We started off with a beginning debit balance of 2 million, and then we had a credit of 130,516. So therefore, based on this information, as mentioned, the journal entry is similar to physicians leasing as follows. We debit the cash. Each period we receive 130,516. Then we have our interest revenue, which is calculated based on the current balance in the lease receivable multiplied by the 12% interest rate divided by 4 payments per year. So our interest revenue is 56,085. Therefore, the decrease to our lease receivable is the difference. All right, so that's how we go through the first problem. This is a finance type lease for the lessee and a sales type lease for the lessor. So this brings us to our next question. All right, so let's move on to the next question. So here we see let's get back here. All right, having a little technical difficulty. Give me a second. All right, and we're going to continue to move on with leases, and the next question is fairly similar. Whereby we essentially have to factor in how do we determine the present value of the lease amount, and then we also have to factor in, okay, how much or what the journal entry essentially is going to be in each of these varying scenarios. So I'm just getting it pulled up. So thank you for your patience. You gotta love technology. All right, so here we are making some headway. Okay, just give me a few more. All right, perfect. Here we are. We are back and ready to go. All right, let's see. Don't think we'll have any issues now. Perfect. All right, there we go. So now we move on to the next question. And here it states on the requirements, determine the price at which the builders is selling the equipment, present value of the lease payments on June 30th, 2024. What amount related to the lease would builders report in its balance sheet on December 31st, 2024, ignore taxes? And what line item amounts related to the lease would builders report in its income statement for the year ended December 31st, 2024, ignoring taxes? All right, so here we start off with this question as follows. It's asking us for the present value, pre-tax net receivable, and the total pre-tax effect on net income. So it states on June 30th, 2024, Georgia Atlantic Incorporated leased warehouse equipment from Builders Incorporated. The lease agreement calls for Georgia Atlantic to make semi-annual lease payments of $562,907 over a 3-year term, which is also the assets used for life. So as we know, there were 5 criteria to determine how a lease should be classified. So since this company is using up the major part of the economic life of the asset, this would be considered a finance type lease for the lessee and a sales type lease for the lessor. The payments semi-annual basically means twice a year, and it lets us know here that it's payable each June 30th and December 31st, and the first payment is on June 30th, which is the same day that the lease starts. It states Georgia Atlantic's incremental borrowing rate is 10%, the same rate builders use to calculate the lease payment amounts. Builders manufactured the equipment at a cost of $2.5 million. So we would factor it in as follows. So in order for us to determine the present value of the lease payments, we need to determine, all right, well, what's the annual lease payments? We don't need to do much there because the problem already lets us know how much it is. So the problem lets us know it's $562,907. How do we know that? Lets us know right here that they're going to make semi-annual lease payments. Next, we need to factor in the present value of the annuity due factor. So how do we determine that? The number of periods is going to be 6. How do we know? It says it's a 3-year lease term, but they're making payments twice a year. So 3 times 2 gives us 6. Next, for our interest rate, it says that they have an incremental borrowing rate of 10%. That represents interest for the entire year, and we are making payments twice a year. So therefore, 10% divided by 2 is 5%. So we factor in the present value of an annuity due of $1. And the key distinction, just to ensure that you understand, when we have an annuity due, that is when the payments are at the beginning of the year, and ordinary annuity is when the payments are going to be made at the end of the year. So in this problem, in both problems we just saw, the payments were made at the beginning. So not necessarily at the beginning of the year, but at the beginning of the lease term. In this case, the lease started June 30th. The first payment is at the inception, at the beginning. So we use this present value of an annuity due. So the number of periods, 6, which equates to 3-year lease term times 2 payments per year, 6. And our interest rate is 5%. The yearly interest rate is 10%. Divided it by 2 because we're making payments twice a year. So therefore, we connect the dots. 6 years, 5%. So our present value of an annuity due factor is 5.32948. So therefore, in order for us to determine the present value, we multiply it as follows. So 562,907 multiplied by our present value factor. All right, so if we round it, you basically get about 3 million. So therefore, the present value, 3 million. All right, next we want to determine what is the pre-tax net receivable. And again, they want to round it to an even dollar amount. So just keep that in mind. So even though it was 3,000,001, they want to round it to an even dollar amount. So just keep that in mind. So 3 million, then it's factoring in our pre-tax net receivable. So if you think about it, the beginning balance on June 30th was 3 million. And then on June 24th, we need to factor in what was the reduction. So on June 24th, we made our first lease payment of $562,907. And then the next thing we need to factor in is, well, okay, what is the amount that reduced our lease receivable as of December 31st? So we'll get our T accounts ready. So here we have lease receivable. The original balance in the lease receivable was 3 million. And then we had a payment of 562,000, which created a decrease to the amount. So $562,907. So as of December 31st, the balance in our lease receivable decreased from 3 million to $2,437.93. So considering this information, our lease receivable balance is $2,437,000, and we factor in the yearly interest rate divided by the number of payments, which is 2. So this 121,000, let me actually put it here. So we want to determine the interest amount. So interest amount, which we just calculated, the 2,437,000, which represents the balance. And then we have our 10% divided by 2 payments per year. So this represents the amount that is treated as interest, right? So therefore, the difference between these two amounts would essentially be the reduction. So 562,907 minus the amount that was allocated to interest. Therefore, the reduction to the lease receivable would be 441,052. So you might say, hold up, this isn't making sense. So I'll put it in journal entry format. so that way you can get a better understanding. So the journal entry would be as follows. So we'll look at the journal entry as of December 34th. So we have the lease payment, which we know is always going to be cash received. So they promise they're going to pay us. Let me debit the cash. They debit the cash for $562,907. And then from there, we need to determine the interest revenue. And as mentioned, how do we determine the interest revenue? It is the current balance in the lease receivable multiplied by the interest for the entire year divided by the payments each year. Since it's semi-annual, it's 2 payments per year. So the interest revenue is $121,855. So therefore, the difference between the cash payment and the interest revenue, this $441,052, this amount represents the decrease to the lease receivable. Hence, up above, when it asks for the reduction as of December 31st, this is why we input. I'm going to make this negative since it's reducing the balance. $441,052. So therefore, to get the net receivable, the amount would be $1,996 and $1,996,041. All right, so that will be our answer for question 2. And now for question 3, it asks for the total pre-tax effect on net income. So we would determine that amount as follows. So amounts reported on the income statement for the year ended December 31st. So June 30th, the interest revenue was 0. We didn't earn anything. Now for December 31st, based on a journal entry, the interest revenue was $121,855. Now the next thing we factor in is, well, what was our sales revenue? So when we recorded, or we factored in the first part of what's taking place, the interest revenue, or the sales revenue rather, in this case is $3 million, which is the present value of the annual lease payments. So $3 million. And the cost of goods sold, it lets us know that they manufactured the equipment at a cost of $2.5 million. So 2.5. So the selling profit in such case is the sum of the $3 million, which represents the present value of the lease payments, less the cost of goods sold, is $500,000. So therefore, in order to determine the total pre-tax effect on net income, we add the interest revenue plus essentially the the sale amount, or the difference rather between the sale, which would be our gross profit or selling profit. So in such case, the total impact would be $621,855. All right. So I know there's a lot going on in this problem, but again, same concept and fairly similar to the first question. So we move on to the next question. And here it's asking us to prepare a lease amortization schedule, appropriate entries for Edison leasing from the beginning of the lease term through January 1st, 2025. Edison's fiscal year December ends December 31st. Edison Leasing leased high-tech electronic equipment to manufacturer Southern on January 1st, 2024. Edison purchased the equipment from International Machines at a cost of $112,080. So the lease term is for 2 years. There's 8 quarterly periods. There's quarterly rental payments, so therefore we are making payments every 3 months, which is the equivalent to 4 times a year. And the rental payments is $15,000. The economic life of the asset is 2 years, which is equivalent to the lease term. So therefore, this is a finance type lease for the lessee and a sales type lease for the lessor. The fair value of the asset is $112,080, and the implicit rate also, the lessee's incremental borrowing rate is 8%. So the problem is asking us to prepare the lease amortization schedule. So first things first, we want to determine what is the value, what's the present value of these payments. So similar to before, the payment is going to be made at the beginning of each period. This is present value of an annuity due. So in such case, the number of periods would be 8. How do we determine that? It's a 2-year lease, as the problem lets us know, and they're making payments 4 times a year. So 2 times 4 gives us 8. As it relates to the interest rate, it lets us know that the yearly interest rate is 8%, and we are making payments twice a year. So therefore, the interest rate is 4%. So we know our annual lease payments. The problem lets us know it's $15,000. So now the next step is essentially for us to determine what is our present value factor. So we essentially have all the information we need. So we go to our present value table. Let me just update this. All right, so we go to our present value table. We know the information. The number of periods is 8, and the interest rate is 4%. So we connect the dots. So 8 represents the period. 4 represents the interest rate. So therefore, make sure I'm at the right place. Oh, well, I actually did that wrong. It should be 8% divided by 4 periods. So it will be 2%. Right? So let's go back just to clear up any confusion. The lease term is for 2 years, and it lets us know that they're making quarterly payments. So therefore, there is going to be 4 payments per year. In total for 2 years, is going to be a total of 8 payments. Next, we factor in this yearly interest rate, which is 8%. And since we're going to be making payments 4 times a year, the interest would be 8% divided by 4 payments per year. So therefore, the interest rate should be 2%. So my apologies. So we know the number of periods, 8, and the interest, which is 2%. So therefore, the present value of an annuity due factor is 7.47199. So to determine the present value of these lease payments, here we have the 15,000 multiplied by the present value factor. And if we round it, all right, we see it's the 112,080. So now we get back to the problem, and we see that as of January 1st, 2024, the lease balance is the 112,080. And then as of January 1st, we made our first payment of 15,000. So the decrease in balance will be 15,000. So the lease balance after we make that first payment decreases. So 112.80 minus 15,000, the balance decreases to 97,080. So now we need to keep determining, all right, well, what is the effective interest? So in order for us to determine the interest revenue as of April 1st, it will be as follows. The lease balance, which is 112,000 minus the 15,000 multiplied by the 2%. So we need to make sure that we are factoring in what is the carrying balance. So the original balance minus the decrease in balance times the quarterly interest rate, which is the 8%, divided by 4, which gives us 2%. So therefore, the effective interest is 1,942. So in order for us to determine, we need to figure out here, what is the decrease in the balance? So the decrease in the balance will be the 15,000 minus the effective interest. So each time we go through the scenario, we'll get the same. So we need to determine how much is interest and how much is a decrease in balance. So every time we look at the problem, we start off with what was the last balance in the lease. And then from there, we factor in the decrease in the balance. It was $84,022. So now we factor in the same thing. $84,022, which represents the previous balance minus the decrease. We multiply it by 2%. That gives us effective interest of $1,680. So in order to determine the decrease in balance, it's the lease payment minus the amount that was allocated to interest of $1,320. In order to determine the lease balance, it is the previous balance minus the decrease in balance. All right, and we basically go through the same thing for all of the problems. 70,000 multiplied by 2%. Now we need to determine how much was the decrease in the balance. From there, we determine the lease balance, the previous balance minus the decrease. All right, so 70,000 minus. All right, so we basically keep doing the same thing. The current balance multiplied by the 2%. And our decrease in balance is the lease payment minus the interest allocated. All right, so we basically keep doing the same thing. So the good thing with the lease, the amortization schedule would generally be provided by the company that is leasing the item. So you'll get to see exactly how much is being allocated to interest and principal. So as we see, the amount is decreasing the more payments we make. So a less amount is being treated as interest and more is going towards the principal balance. All right, so we are almost at the end. We multiply that by the 2%. Nope, something's wrong here. Let me see. So equal the balance minus perfect. Something's a little off with my math today. Or maybe it's the formula. So 29 minus. Oh, there we go. I see what I'm doing wrong. All right. And then now we made it to the end of the 8-year period. So keep in mind, at the end, the total decrease in the balance is going to be equivalent to the face value, which in this case, or the present value of the payments, which is $112,080. That's going to be the total decrease in the balance. So in order to determine, so it's kind of like a plug. The last payment is basically going to factor in anything that was missed due to rounding. So you have to keep that in mind. So the total amount of $112,080 minus all of the total decreases to date. So this is another way to, kind of handle this. All right, this way isn't working. All right, so we have 294. 15,000 minus 294 gives us 14,706. But one of the things we need to do is we have to adjust for the rounding of the other numbers. So therefore, because if we add this up, we get the 12,080. All right. and we factor in these amounts. All right, so this should be check here 14,135. And again, a lot of this is a bit off because of the rounding. All right, but for the most part, the key thing is that at the end, the decrease in balance should be 112,080, but there are going to be some differences due to a rounding. So you just want to keep that in mind. So if you're going through the problem and it's telling you that it's incorrect, it's probably because there's, a bit of difference as it relates to maybe like $1 or so. So just keep that in mind. So after we account for the 14,706, the lease balance now decreases to 0. So now the next part of the problem is asking us to record the journal entry that needs to be prepared for the leasing from the beginning of the lease through January 1st, 2025. So as we start to factor in the lease amount and how that is going to play out, again, it's not just about the lease amortization. There's also some things that need to be accounted for as it relates to the journal entries that need to be prepared. So in such case, the journal entry is going to be as follows. So here we see there's a lease receivable. So we would account for it as follows. Lease receivable as our debit for 112,080. We credit the equipment account for 112,80. And then next on January 1st, we factor in the cash as follows, because again, we know we're receiving 15,000. So we credit cash for the 15,000. We credit our lease receivable for the 15,000. Next, we factor in on April 1st. It's asking on April 1st, what is going to be the journal entry? So we know one thing for sure, we're always going to be receiving cash of 15,000. And the problem already essentially gives us the information. We know of the $15,000 payment, 1942 is going to be treated as interest revenue, and 13,058 would be treated as the decrease in balance for the lease receivable. So our journal entry would be as follows. You would credit the lease receivable for the decrease in balance. We will credit the interest revenue. So the lease receivable decrease is 13,058. For the interest revenue, it is 1942. Next, we move on to July 1st. And similar concept, for July 1st, we debit cash, credit lease receivable, and credit interest revenue for the amounts. So cash, again, is always going to be 15,000. From there, we credit the lease receivable for the decrease of 13,320, and the interest revenue for 1680. Now, the next part of the problem is going to ask us for October 1st. Again, same thing. Cash, lease receivable, and interest revenue. And we already have the amounts here. We have the amortization schedule. So we have cash of 15,000. We have a decrease to our lease receivable balance of 13,586. And our interest revenue is 1,414. So now for December 31st is going to ask us essentially about the interest in which we're receiving as of January 1st, 2025, the amount that we are expecting to receive. So therefore, our journal entry is going to be as follows. Interest receivable the amount that has accrued that we are expecting to receive, and our interest revenue. So therefore, if we go back up and we factor in as of January 1st, how much we were expecting to receive in this case was 1,142,000. So therefore, 1,142,000, 1,142,000, because on the accrual basis, we recognize the interest that we are expecting to receive. So this is recording the journal entry on an accrual basis, the amount that we are expecting to receive. And now comes January 1st, we actually get the amount. So therefore, our journal entry is going to be cash. Remember, that amount doesn't change. We're still receiving 15,000. But now what does change is, hey, we already recorded the interest revenue at the end of last year. So therefore, here we see lease receivable. And we scroll back up to our amortization schedule, and we see that we anticipated receiving $13,858. Or the decrease rather was the $13,858. Now, instead of, again, crediting interest revenue, we are now decreasing the interest receivable that we've already set up because we are now receiving payments. So therefore, we debit or credit rather interest receivable for the 1,142. All right, so this brings us to the end of question 4. Again, I know there's lots of tabs and things for us to consider, but the key thing is, again, just keeping in mind that as these transactions are taking place, there's some key things that we need to factor in. Is this a sales lease? Is this a operating lease? And if it's an operating lease, then obviously we're going to treat it as a rental. But for the most part, when we have these types of leases and they're a sales type lease, in such case, we need to account for it as a right of use asset. On behalf of the lessor, we need to factor in that there is a lease receivable. So there's a lot of nuance and things to keep in mind as we are recording these journal entries based on the classification of the lease. All right, so this brings us to our next question. All right, so here we move on to the next question. Question 4, again, having some challenges. Here we go. Fix. All right, so here it's saying prepare appropriate entries for Newton Labs to record the arrangement at its commencement, January 1st, 2024, on March 31st, 2024. And 2, prepare appropriate entries for Brookline Instruments to record the arrangement at its commencement, January 1st, 2024 to March 31st, 2024. So here we see Newton Labs lease chronometers from Brookline Instruments on January 1st, 2024. Brookline Instruments manufactured the chronometers at a cost of $200,000. The chronometers have a fair value of $260,000. We see that the lease term is for 5 years. They're making quarterly payments. So I'm sure by now we understand the concept. 5 times 4 gives us 20 quarterly periods or 20 payments. The quarterly lease payments is $14,547, of which the first payment is going to be made when we first lease it. The estimated residual value of the chronometer at the end of the lease, $25,823. And the interest rate charged by the lessor is 8%. So we start off looking for this first journal entry. So one of the first things we need to, again, determine is what is the present value of the payment. So we already have our present value, table open. So we factor it in as follows. Just gonna copy this over. All right, so the annual lease payment, as the problem lets us know, is going to be $14,547. And now the next thing we need to do is to factor in what the present value of an annuity due factor is going to be. So make sure this is in space so we can kind of see it. All right, perfect. We can delete this. Here we go. So the present value of an annuity due factor. So based on this information, again, there's an 8% interest rate. And there are 4 payments per year. So 8% divided by 4 gives us 2% rather. And we have 20 periods. So we go to our chart, 20%, 20 periods rather at 2%. Gives us a present value factor of 16.67846. So therefore, the lease payment present value is $242,622. So therefore, our journal entry is as follows. And we're recording it on behalf of the lessee. So we have a debit to right of use asset for the $242,622. And we credit lease payable because now we have a liability to pay off this lease. Next, for January 1st, we have the payment. So we have a decrease to our lease payable. We made the payment the same day we took out the lease, so therefore no interest has accrued. So the entire $14,547 is allocated to interest, and we credit cash because cash is being paid. All right. Next, we move on to March 31st. So as we mentioned earlier, and we saw in previous problems, we need to account for the amount that's being treated as interest expense, which would be factored in as follows. So we have interest expense, and we factor in the amount as follows. So the original balance in our lease payable, which was $242,622, minus the decrease to lease payable from our first payment. So I'll put these in brackets. And then from there, we multiply this amount by the 2%, which is the annual interest of 8% divided by 4 payments per year. So that gives us interest expense of $4,562. We know that for each period we're paying $14,547. That doesn't change. The difference represents the decrease in the lease payable amount. All right. So now we move on to March 31st, 2024. So for March, it's asking us essentially about the amortization expense. So as it relates to the amortization expense, we essentially have to factor in the 20 quarters each year. So when both the present value of the lease payments and the present value of the residual value are included in the lease receivable. So in such case, because the two amounts, they're combined to allow the lessor to recover, it's $260,000 as a net investment. So the problem lets us know that they had a fair value of $260,000. So, but for its sales revenue, the lessor is essentially going to have to include a residual value only if it's guaranteed, because in such case, the lessor is going to be assured to receive the residual value either in cash or in the value of the asset that is going to be returned. So as we have to factor in this amortization is mentioned, with the amortization, so like other non-current assets, the lessee's right of use asset, it provides an economic benefit. So these are one of the things that we have to account for. So we didn't see them in previous problems, but in this problem, it is asking us to account for amortization. So like as mentioned, other non-current assets, the lessee's right of use asset provides an economic benefit, which is the use or the right to use a productive asset over the period of the covered lease term. So therefore, the lessee will amortize the right of the use of asset over the lease term. Generally, the amortization is basically on a straight line basis for the most part, unless the lessee's pattern of use is different. The amortization, it results in an expense for the lessee. So in such case, we see that the amount is $242,622, and this is the right of use that is going to be amortized. So $242,622, we'll divide it by the number of periods, which is 20 periods. 5 years, 4 payments per year. So therefore, our journal entry would be as follows. We debit the amortization expense and we credit the right of use asset for the $12,131. So again, how do we determine the amortization expense? We divide the right of use asset by the number of periods, which in this case is 25 years times 4 payments per year. So therefore, we amortize the right of use asset on a straight line basis. All right. So now we factor in for Newton Labs. So this was for Newton Labs. And this part of the entry is asking us to prepare the appropriate journal entries for Brookline. So in such case, Brookline manufactures the equipment. So now again, we have to factor in what are the journal entries going to be on behalf of the lessee. So the lessee and the lessor, the journal entries, again, they are fairly similar. The amounts for the most part are generally the same. The key thing, again, that we need to factor in is what journal entries are going to be recorded. So for this part of the journal entry, we factor in the lease receivable. So this is similar to a problem that we saw before. So we factor in the lease receivable. And again, we need to determine the amount. So the problem lets us know, and again, let's use what we don't know. So it tells us here that the chronometers have, where did it say? They have a cost of $200,000, and it says that it has a fair value of $260,000. So if we are going to, account and sell the asset, we need to essentially factor in what that amount is. So in order for us to determine it, it's equivalent to the fair market value. And keep in mind that the fair value is essentially discounted based on the present value. So therefore, the lease receivable is equivalent to the $260,000. From there, we factor in the cost of goods sold. We're going to set up the entries. First, cost of goods sold. We factor in the sales revenue. And then we factor in the value of the equipment. So we use what we do know to figure out what we don't know. So we know the fair value, which is $260,000. And this is essentially equivalent to the present value of the payments that are being made each year, in addition to the estimated residual value of the chronometers at the end of the lease. So once we factor these, based on the factors, the present value of $1 and the present value of an ordinary annuity. We need to factor in these two things. So this estimated residual value of chronometers at the end of the lease would be factored based on the present value of $1. So for the most part, we've always been using the present value of an annuity, but we also want to factor in this $25,823 that we expect to receive at the end of the lease term. So I'm actually going to do the calculation so we can see it. And I'll just copy these, make it a little easier. I'll just list it twice since we have to look at the calculation twice. So we already know the present value here. We calculated it before. So it's the 14,547, which is a quarterly payment multiplied by the present value of an annuity due. But now we're factoring the present value of $1. All right, the present value of $1 is going to be factored in for this expected residual value. So estimated residual, I'll just put estimated residual of 25,823. So this is going to be based on 20 periods, because again, it's 5 years at 4 payments per year. And then we have 8% for the entire year divided by 4 payments, which is 2%. So we go to our present value of $1 factor. We have 20 periods. And then we have 2%. So the factor is 0.67297, which gives us 17,378. So if we add the two, the present value of the annual lease payments plus the estimated residual discounted to the present value, that is how we calculate the total 260. So the problem pretty much, did the hard work for us. They let us know what the fair value is. And again, that is why we are recording the lease receivable for the lessor at $260,000. So that's the first part of the journal entry. We know the lease receivable amount is going to be equivalent to the fair market value. And again, we just calculated how that amount was factored. Our sales revenue is going to be equivalent to the present value of the lease payments. So the present value of the lease payments is we just calculated, which is $242,622. And next we have the amount that the equipment was manufactured for. The problem lets us know there's no extra math that needs to be done. So the equipment is valued at $200,000. So we remove it off the books. So therefore, the cost of goods sold is going to be calculated as follows. It's the sum of the sales revenue plus the equipment that we're writing off the books minus the accounts receivable. So therefore, the cost of goods sold in this case is $182,622. So I know with this problem, there's a lot of extra work that goes into it again, because in this case, there's an estimated residual value of the chronometers at the end of the lease term. So that would be the first portion of our journal entry. Next, for the lessor, they receive cash of $14,000. The first journal entry is always fairly straightforward, $14,547. And they credit the lease receivable for the $14,547. And then on March 31st, we account for the cash. And then there's going to be a decrease to the lease receivable, but not for the full amount, because a portion of it is going to be allocated to interest. So our cash amount remains the same, $14,547. The lease receivable amount is going to be calculated as follows. The original balance in lease receivable minus the decrease to lease receivable multiplied by the quarterly interest rate, which is 2%. We round that off. So therefore, the interest revenue is the difference between the cash received and the amount allocated to interest revenue. All right, so again, I know there was a lot going on with this problem. Just keep in mind, because there's the estimated residual value, in order to determine the lease receivable, you need to factor in the present value of the annual lease payments, in addition to the present value of the estimated residual using the present value of $1. So I'll just highlight this in green as well, so that way you can see how this was factored. I'm going to update this to make sure the number is tied. All right, so this brings us to the end of question 4. So we move on to the next question, question 5. So here it asks, prepare the appropriate journal entries recorded by Nath Langstrom Services for the first year of the lease, and prepare the appropriate journal entries reported by Computer World for the first year of the leasing. So it says on January 1st, it says on January 1st, 2024, North Langstrom Services Incorporated, a computer software training firm, listed several computers under a 2-year operating lease. Okay, so now we see there's a difference. Before we were dealing with finance leases. Now we are finally getting the opportunity to look at how an operating lease is essentially accounted for. So here we see they routinely finance equipment from other firms. We see that the contract calls for 4 rent payments of $10,000 each, payable semi-annually on June 30th and December 1st. The computers were acquired by Computer World at a cost of $90,000, expected to have a useful life of 5 years with no residual value. Both firms record amortization and depreciation semi-annually. So one thing to keep in mind, when we're dealing with an operating lease, the lessee, the user, they determine interest the normal way based on the effective interest rate, and then they basically plug in the right of use asset amortization at the amount needed for the interest plus amortization. So you might be saying, this doesn't make any sense. We'll go through the problem to, hopefully clear that up. So the first thing we need to factor in is, all right, well, we always start off with, what is the present value? I'm going to copy this. We should be familiar with how to do this already. All right, and here's one difference. So generally, we were using the present value of an annuity due, but we see here that they leased it on January 1st, but payment is not going to begin. Payment will not begin until June 30th. So this would be considered present value of an ordinary annuity. The payments are taking place at a later time. So therefore, in this case, we use the present value of an ordinary annuity of $1 to determine the amount. So the present value of the annuity due factor, here we see that it is a 2-year lease, and it says that payments are going to be semi-annual. So therefore, the number of periods would be 4. 2 years times 2 payments each. 2 times 2 gives us 4. It lets us know that other firms, they routinely have an interest rate of 4%. And again, payments are twice a year. So therefore, 4% divided by 2 gives us 2%. So the annual lease payments is $10,000 is the problem lets us know. Now we essentially need to determine what is the present value of an ordinary annuity factor. So we calculate the amount as follows. We go to the chart. The present value, we know the number, which is 4, and we know the interest, which is 2. So therefore, we multiply it by 3.80, 3.80773. So that gives us present value of an ordinary annuity factor of 38%. $38,077. So the first part of our journal entry, we would debit it as a right of use asset for $38,077, and we credit lease payable for the $38,077. And now again, we see the distinction with this problem because the first payment does not take place on January 1st. It takes place on June 30th of the same year. So therefore, we factor it in as follows. We know one thing for sure, we're going to be paying a total cash amount of $10,000. That is not going to change. But we know that a portion of this cash payment is going to be allocated to interest expense. And then another portion of it is going to decrease the balance for our lease payable. So how much is going to decrease our lease payable? How much is going to be our interest expense? We determine it as follows. So our interest expense is a $38,000 multiplied by the annual interest divided by 2, 4% divided by 2. So therefore, the interest expense for June 30th is $762. The lease payable amount will be calculated as follows. $10,000 minus the amount allocated to interest of $762. Therefore, $9,238 would be allocated. And now on June 30th, we also need to factor in the amortization expense. So as mentioned, in the operating lease, the lessee determines the interest the normal way at the effective interest rate. So they basically plug the right of use asset amortization at the amount that's needed for interest plus amortization equal to the straight line lease payment. So therefore, the journal entry is going to be as follows. The amortization expense is always going to be equal to the decrease to the lease payable account. So therefore, the journal entry on June 30th to allocate the amortization expense is $9,238 and a credit to the right of use asset. Now on December 31st, we record our journal entry to account for the payment. Again, we're always going to pay $10,000 in cash, but then we need to factor in, all right, well, what's our interest expense? How do we determine that amount? So it is our lease payable amount, the original balance, minus the decrease as of June 30th, multiplied by the 2%, our interest expense, rounded, is $577. So our lease payable is the cash paid minus the amount allocated to interest. The lease payable is $949,423. For December 31st, again, the value that is going to be allocated to amortization expense is equivalent, oh, wrote this in the wrong place, is equivalent to the decrease for the lease payable for that period of $9,423. So that's how we would factor in for requirement 1. For requirement 2, we would essentially account for it as follows. So on January 1st, no journal entry required. Why? Again, this is basically just a rental, right? We don't need to write the equipment off the books or anything like that. June 30th, we debit cash. We receive $10,000, and this is treated as lease revenue. And now on June 30th, remember the books, the equipment is still on the books for the company. We did not sell it. They are not essentially going to own it. We still have these computers on the books. So therefore, we need to account for them, and we also account for the depreciation. So therefore, our journal entry would be as follows. We would debit depreciation expense, the regular old, good old depreciation journal entry, and we credit accumulated depreciation. And how do we determine the amount? They let us know that the cost of the asset is $90,000. So 90,000. And we have to divide it by the annual periods. So in such case, it lets us know that it's expected to have a useful life of 5 years, but it's semi-annual. So therefore, 5 multiplied by 2 is 10. So therefore, the depreciation expense for each period is 9,000. So the great thing about having a operating lease for the lessor, all of the journal entries are the same. So for December 31st, we debit cash for 10,000, we credit lease revenue. December 31st, we account for the depreciation expense, we debit depreciation expense for 9,000 and credit the accumulated depreciation for 9,000 as well. So journal entries for the lessor under an operating lease, fairly straightforward. So we move on to the next question. All right, so for this question, it's asking us to prepare the appropriate journal entries for universal leasing from the beginning of the lease through the end of 2024. At the beginning of 2025, there was a significant indication that Desktop's economic incentive to terminate the lease had changed, causing both companies to believe termination of the lease would end in 4 years, 3 years remaining, certainly reasonable. Prepare the entry. 3, prepare the appropriate entry pertaining to the lease for universal leasing on December 31st, 2025. All right, so and this question says Universal Leasing leases electronic equipment to a variety of businesses. The company's primary services providing alternate financing by acquiring equipment and leasing it to customers under long-term leases. Universal earns interest under these arrangements at a 10% annual rate. Universal purchased an electronic typesetting machine for $90,000 and leased it to a local publisher. This 6-year operating lease term commenced on January 1st, and the lease contract specified annual payments of $8,000 beginning December 31st. The machine's estimated useful life is 15 years with no estimated residual value. The publisher had the option to terminate the lease after 4 years. At the beginning of the lease, there was no reason to believe the lease would be terminated. So the first journal entry that we will record on December 31st is as follows. So again, the contract specifies that each period they are going to receive cash of $8,000. So therefore, there's no entry for January 1st, 2024. Nothing we need to account for. So in such case, again, even though the lease term, can be extended as we see in this case, this is still considering operating lease. So therefore, we debit cash for the $8,000 and we credit lease revenue. All right, so fairly straightforward. Now, as it relates to requirement 2, at the beginning of 2025, what's going to happen again? The lease term is now expected. Let's see. The lease term in this case is now, it's going to extend. There's 3 years remaining. 4 years. Let me see here. At the end of 4 years, right? 3 years remaining. So in such case, there's no journal entry. There's nothing we need to account for. So we move on to requirement 3. So requirement 3 is asking us to prepare the appropriate entry. All right, there's just an extension. The journal entry is still going to remain the same. We debit cash for $8,000 and credit lease receivable for the $8,000. All right. So again, sometimes there's a bit of nuance with the lease, but for the most part, the journal entries are, dependent. So here we see they anticipated that it was going to be a lease for, let's see, where's the information? So it's essentially going to be 5 years, right? How do we know? Started December 31st, 2024, extended to 2029. So the difference between 2024 and 2029 is 5 years. So the key difference is that in this case, instead of, it being 5 years remaining at the end of the first year, it's basically going to be 3 years. But again, we're still getting cash of $8,000 and crediting lease revenue for the $8,000. All right, so this brings us to our last question. So here in this question, it asks, prepare the appropriate entries for both carrier and gauche on January 1st. To prepare all appropriate entries for both carrier and gauche on December 31st, 2024. All right, so again, we know one of the first things we're going to need to do is to determine the present value of the lease payments for the lessee. So how do we do that? Present value in this case, or the periodic payments rather. So it says January 1st, 2024, Gauche Industries leased a high-performance conveyor carrier company for a 4-year period ending December 31st, 2027, at which time possession of the leased asset will revert back to Gauche. The equipment cost Gauche $956,000 with an expected useful life of 5 years. Gauche expects the residual value at December 31st, 2027 to be $300,000. Negotiations led to the lessee guaranteeing a $340,000 residual value. Equal payments under the finance or sales type lease are $200,000 and are due on December 31st. With the first payment being made on December 31st, carrier is aware that Gauche is using a 5% interest rate when calculating lease payments. So, all right, the lease starts on January 1st. And the payment isn't being made until the end of the year. So in such case, we use the present value of an ordinary annuity. So the present value of the periodic lease payments, again, in this problem, it lets us know it's $200,000. And then we need to factor in, well, what's the factor, right? The present value, the number of periods is going to be 4 years. And then from there, the interest is going to be 5%. So how do we determine that? So in such case, we have the estimated useful life of 5 years, and there's just payments being made once each year, once a year. And the number of periods going to be for 4 years. So here we have 4 year, and the payment is being made once a year. So therefore, the number of periods is 4, and the interest is 5. So we get a present value factor of 3.54595. All right, so 3.54595. I want to make sure that you all can see. 595. Let's shift these down. I want to make sure we understand how this is being calculated. All right, so the present value of periodic lease payments, 200,000, multiplied by a present value of an ordinary annuity factor that gives us lots of zero there's $709,190. But we also need to factor in the present value of the excess lessee guaranteed amount. So let's get some more space. All right, so the problem lets us know that we can expect there to be an excess of the lessee. How do we know? They expect the residual value is going to be 300,000. They guarantee 340,000. So there's a difference of 40,000. And we need to determine the present value of this amount. So we need to factor in the present value of $1. So we know that the number of periods is 4 and the interest rate is 5. So therefore, our present value of $1 factor is 0.82270. All right. Let's get this to be 870. So therefore, the present value of the lease payments, 40,000, times the present value of $1 factor is 32,908. So therefore, the present value shift this down. All right, this won't work. Okay. So we add these two amounts, the present value of the periodic lease payments plus the present value of the lease payments. So therefore, we see that the value of the right of use asset is $742,098. So our journal entry would be as follows. We would debit right of use asset. Update this. Perfect. So we debit right of use asset for the amount $742,098 rounded, and we credit lease payable for the same amount. Now on January 1st, we need to factor in, all right, what's the present value of these lease payments? So in such case, we will also have to factor in the present value of the residual value. So in the first part of the problem, we only factored in, so this is, similar. And here's one thing that we're missing. So I think to make it easier, here's what we can do. All right, so we factored in the 40,000, but we also need to factor in the present value of the residual value, which is a guaranteed 300,000. So therefore, we multiply I know, let me separate them so that way there's no confusion. This would be the present value, the excess, which is the 40,000. All right, space. And then this would be the present value of the residual value. I'm just going to give some space for both so that way we can clearly see the distinction between the two. The factor is the same. That's just not going to change. So we'll separate the two. So the 40,000 times the amount. And then we get the 300,000 multiplied with the factor. So for December 31st, in order to determine the present value of lease payments for the second entry, we would factor in the present value of the periodic lease payments plus the present value of the excess lessee guaranteed plus the present value of the residual value. So therefore, the total present value of the lease payments would be $988,908. So I think it might be important to have a distinction between the two. All right, so for the first part of the problem, I think it will be important again, just to kind of break it out so that way there's no confusion. So we can have one that says part A, part B, essentially. So for part A, you're just factoring in the present value of the excess lessee guarantee. So I'm going to remove these in hopes to clear up any confusion. All right, so lease yourselves up. 0.8270. All right, so there's a lot of calculating going on right now. Just want to make sure that we have it correct so that way there's no confusion, because there was another part of the calculation that was added for the second portion of the problem. All right, getting back on track. All right, so this was for requirement 1. So this was as of January 31st. And this is for December 31st. All right, now wait, hold up. January 1st, part 1. Let me say, because they're both January 1st. So January 1st, part 1. And then here we have January 1st, part 2. All right, in hopes that that clears up any confusion. So in this part of the entry, again, we factored in the present value of the periodic lease payments in addition to the present value of the excess lessee plus the present value of the residual value. And that is how we calculated the $988,908. So let's quickly wrap this up. The journal entry on January 1st, the second entry will be as follows. We would debit the lease receivable for the $988,908. We would credit our sales revenue for the $988,908. And then the problem lets us know that the cost of the item was $956. So therefore we debit cost of goods sold for $956. And we credit equipment for the $956,000. All right, so that brings us to the end of the entries for requirement 1. Now for requirement 2, it is asking us to account for the entries for both Carrier and Ghost on December 31st. So again, this first part of the entry, this is for the lessee, and this journal entry is for the lessor. So just keep that in mind. Lessee's journal entry, lessor's journal entry. So now for requirement 2, it's asking us to prepare both the entries as of December 31st. So as of December 31st, our journal entry would be as follows. So the problem lets us know that there's going to be a payment. Let's see, $200,000. So one thing we know for sure is going to be cash leaving the company for $200,000. And we know that a portion of it is going to be allocated to interest expense and a portion allocated to the lease payable. So we factor it in as follows. The interest expense is going to be calculated as follows. So it is the total amount, $742,098, multiplied by the interest rate. So in this case, the interest rate is 5%. So the interest expense would be $37,105. So therefore, the difference between the cash of $200,000 paid minus the interest expense is $162,895. The next thing we factor in is the amortization expense. So in this example, we look at the amortization expense under the straight line method. So the total amount, the right of use, $742,098. We divide it by the number of periods. So in this case, it is a 4-year loan. There's no semi-annual payment. So it's just the total amount divided by 4. So the amortization expense, and we credit right of use asset for the $185,525. And now for the last part of the entry, we record for the lessor. So in this case, again, we know how much cash is going to be received for the lessor. They are going to receive $200,000 in cash, that we know. Now we essentially need to factor in what is their interest revenue. So keep in mind, for the lessor, interest revenue, for the lessor, their interest revenue is based on the lease receivable amount of $988,908 multiplied by the interest rate of 5%. Oops, something's wrong with the entry. Interest revenue of 988 multiplied by 5%. What am I doing wrong? Okay. Let's scale back up. All right. Multiply by 5%. Oh, why is this? Oh, here we go. Num's lock is on, so nothing is typing. 5%. So the interest revenue will be $49,000. So therefore, the decrease to the lease receivable will be the difference between the cash received and the interest revenue. All right, so this brings us to the end of the questions for chapter 15, which covers leases. Again, there's a lot going on. So what I will also do is that I will update or upload rather these Excel spreadsheet that ties to what was done in this video. So I hope that this helps. Again, I know that there's a lot to cover with the leases. There's some nuance. One of the key things, again, you want to determine, is this a finance type lease for the lessee? Is this a sales type lease for the lessor? Or is this an operating lease for both the lessee and lessor?